continue with another example in which we will try to value oil reserves by using options. So the example will follow. Ace Chemicals has claims on oil reserves amounting to 5 billion barrels in the South Arkham Sea. Ace's rights to develop these reserves will expire in 30 years. Currently, developing these reserves will cost Ace $20 per barrel. Use crude oil WTI futures as a proxy for the current market price of oil, and production costs per barrel is estimated to be $40 per barrel. Use appropriate risk-free rate for this project, and also how would your model consider the volatility of this project? Factor in the cost of delay of the project in your model and decide whether ACE should start developing reserves now or rather wait. So the solution, first let us define the inputs of our model and what kind of assumptions we need to make to complete the model. In this example, S, the value of the underlying asset, will be the total monetary value of the oil reserves as we have that kind of info to calculate the value. Nonetheless, if we were presented with the present value of after-tax cash flows generated by these reserves, this could also be the value for S. And X, the strike price, will be the cost of developing these reserves. Again, S minus X, which represents the value of the coal at expiration or now, stands also for the profit resulting from exploiting these oil reserves. So the coal value found through Black-Scholes will somewhat represent the potential profit or value extracted from this project. Also recall that coal value will also contain the option to delay this project. So what we are after here is the value of the call. Based on this, we will decide whether Ace Chemicals should start the project or delay the project. And sigma volatility, or the standard deviation of the returns on the underlying asset, can be assumed to be equal to the standard deviation of the returns on oil prices. I will show you the detailed analysis concerning how I calculated the relevant volatility value for this model. And T, capital T, remember this is time to expiration, will be number of years ACE has right to develop these oil reserves. It was 30 years, as you will remember. And R will be the appropriate risk-free rate, and I will be using the yield on US 10-year treasuries, also because the duration of the project matches the time to maturity of the bond. And B, small letter B, cost of delay or dividend yield, can be assumed to be the annual cash flows lost from the project as a percentage of the present value of all future cash flows from the project. Essentially, it represents what you lose annually if you are to delay the project. In this kind of a project, you need to consider cost of delay because any year not spent on extracting the reserves, company loses money. Also because the company has the rights to develop the reserves for a fixed 30-year time period starting now. For the risk-free rate, as you will remember, we have this information taken from the Wall Street Journal. The link is here. So the yield on US 10-year treasury bond is 4.373%, and this will be the input variable for the risk-free rate in our Black-Scholes model. And also crude oil WTI, this is the current value standing at $62.8. So current price of a barrel of oil. This is as of 4th of April 2025, after US had imposed tariffs on its trading partners. So hence the drop in the price, at least for the time being. And so from the investing.com, actually, you can sort this data, make time frame monthly, and I started from 2014 and ended it at the beginning of 2025. So you will be then getting this monthly data. So I sorted the column by date and started from oldest to newest here. But again, what I have is monthly values. I need to have annual values so that I will be able to calculate annual returns on oil prices. So using filter tool of Excel, I just entered January, Jan here, and then I filtered by the month of January, and this is what I will get in the end. So based on these values, you can calculate annual returns. We have the prices here. So we have the prices here. So based on these prices, you can calculate the annual returns between these years and then calculate the average. This is the long solution, by the way, because after already having the annual returns, you can just calculate the standard deviation very easily by using the standard S Excel function. But I also showed you the long solution just as I have been doing throughout the chapter. So this is the average mean. Then calculate the deviation for each annual return from the mean and take the square of these deviations. So variance will be sum of these deviations squared divided by number of observations minus 1 because we are looking at the past data. So we will be following the sample convention here. And variance Excel, just use variant.s, variance for the sample, and based on these annual returns you should be getting the same data or the same result, I would say. And for the standard deviation manual, you have calculated the variance, just square root of this value, you should get this. Or by using the Excel function of standard deviation for the sample, just use the input value for these annual returns and you should get the same value as that calculated by the manual solution. So we have all the necessary information for all of the input variables of Black-Scholes. Recall that Ace Chemicals has claim on reserves of 5 billion barrels of oil. So rights to develop these reserves will expire in 30 years, and cost of developing these reserves is given as $20 per barrel, and current oil market price is $62.08 per barrel. See slide 210. And production costs are given as $40 per barrel. So S will be 5 billion multiplied by the difference between the current price and the production costs. So S will be $110.4 billion and X will be 5 billion multiplied by $20 and $100 billion, and T will be 30 years. Risk-free rate will be 4.373%. You can see this on slide 209. And sigma volatility of oil prices was calculated as around 35%. You can see slide 213. And B cost of delay 1 over 30, around 3.3333%. So to underscore this point again, the company has rights only for 30 years. So each year passed without extraction and generation of cash flows from the reserves, the company will lose money. For example, if 5 years pass without extraction, the company will lose 5 over 30 of all future cash flows. So cost of delay takes this effect into account. Remember, dividend yields tend to reduce the price of the call, so cost of delay will have the same effect by reducing the price of the call. So here I entered all input values here: stock price, strike price, volatility, risk-free rate, time to expiration, and the cost of delay in terms of dividend yield. So then I will get this value. So Black-Scholes call option with an option to delay developing the reserves has a value of $29.63 billion. The net present value analysis will yield $10.4 billion. Actually, this is basically the difference between the stock price and the strike price. So ACE should delay the development of the oil reserves because this will be the more optimal strategy. High volatility of oil prices at 35% coupled with the long time to expiration at 30 years makes the option to delay the project more valuable, while also delaying the option doesn't relatively hurt the company much. And remember that in these examples, we need to take the cash flows lost because of delaying the project into account. Because the company has claims to extract oil for a 30-year period. In each year oil is not extracted, the company will be losing 1/30th of all future cash flows generated by these reserves. The contract lasts for 30 years, and each year without extraction and generating cash flows from reserves will cause company to lose money, which is captured by this cost of delay value embedded into the dividend input of the Black-Scholes model here.